Have you ever seen magicians distract you with one hand while the real trick happens in the other? You focus on what looks obvious, but that's not where the action really is. In trading, something very similar happens with a concept called induced liquidity. So, what does induced liquidity mean? It's when the market tempts traders into entering positions in the wrong direction, only to use their orders as fuel for the real move. The market creates an illusion, an attractive setup just to trick traders into placing orders that bigger players can then take advantage of. Think of it like a supermarket offering a flash sale sign. Shoppers rush in, convinced it's a deal. But when they get to the register, the discount isn't real. The store simply wanted to pull people inside. That's induced liquidity. Bait to attract participation. In the market, induced liquidity often happens near obvious levels, like clear support or resistance. Price might fake a breakout or drop just below a floor, luring traders into chasing the move. But once enough orders are trapped, the market flips in the opposite direction. Why does this matter? Because bigger players need liquidity to fill their orders. They can't just buy or sell huge positions in the middle of nowhere. They need a crowd of traders on the other side. So the market induces that liquidity by tricking traders into entering at the worst possible place. Let's make it even simpler with an everyday example. Imagine a crowded bus stop. The bus company only wants to send a bus if enough people are waiting. So they post a fake schedule that says a bus is arriving. People gather, and once the crowd is big enough, the bus shows up. But maybe it's headed the opposite way. That's induced liquidity. The illusion is created to gather participation. In charts, induced liquidity shows up in different forms. One is the false breakout. Price pushes above resistance, pulling in breakouts buyers, then reverses down. Another is the stop hand. Price dips just below support, triggering stop losses of buyers, then bounces sharply up. Both are classic ways the market collects liquidity before moving where it really wanted to go. Here's the psychology. Imagine traders starting at resistance. They think if it breaks, I'll buy. The moment price pokes through, orders float in. But that's exactly what bigger players needed, a pool of buy orders to sell into. Once they filled their large sell positions, price reverses, leaving retail traders trapped. So how can you avoid falling into that induced liquidity trap? First, understand that the most obvious levels are often where these tricks happen. If something looks too clean, too easy, it might be a trap. Second, wait for confirmation. Don't enter just because price touches it or poke through the level. Look for how price reacts. Does it hold or does it reject back quickly? The third is to use patience. Often the best move comes right after the trap is sprung, when price reverses sharply. Let's put this into numbers. Suppose Euro USD is stuck under 1.1000 for days. Traders set buy stops just above. Price finally breaks to 1.1010, breaks out, traders jump in. Stops triggers, and then within minutes price collapses to 1.0950. What happened? The breakout wasn't real. It was induced liquidity. The market went above 1.1000 only to grab those buy orders, then flip the other way. Here's another analogy. Imagine fishing. A fisherman throws bait into the water, not because he wants the small fish, but because the bait attracts the big catch. Traders chasing the bait are like the fish. They rush in, not realizing they're being used to serve someone else's plan. To recap, induced liquidity is when the market tricks traders into entering, just to use their orders as fuel for the opposite move. It usually happens near obvious support or resistance, or through false breakout or stop hands. The key to avoiding the trap is patience, skepticism of too perfect setups, and waiting for confirmation before you commit. In short, induced liquidity is the market's way of gathering energy. It creates the illusion of a breakout or a breakdown, pulls traders in, and then uses that fuel to power the real move in the opposite direction. If you learn to spot it, you'll stop being part of the crowd that gets trapped and start trading alongside the players who set the trap.